While most of you know that India is the fifth largest country in the world in terms of GDP, it is the number one in terms of population. But you also know India now has the seventh largest bank in the world. Yes, I'm talking about the merger of HDFC Ltd and HDFC Bank. So in today's video, I thought of giving you more insights on this big bank merger of $40 billion, which happened in the month of July. Let's look at the key numbers and developments post this merger. So the market valuation of the merged entity is around $154 billion, which makes it almost double that of the next largest bank, ICICI Bank in India. It makes it the seventh largest bank in the world, with market valuation slightly more than the Bank of China and little lesser than the HSBC holdings. The HDFC Ltd, which got merged into the bank, had standalone PAT of around 26,000 crore. It had greater than 30% share in the home loan market and with assets of close to 7 lakh crore. The top leaders of HDFC Ltd, who are very well respected and known in the industry, the chairman Mr. Deepak Parekh, the vice chairman Mr. K.K. Mistry, and the managing director Mr. Renu Sood Karnar, they all have hung their boots. Now, if you look at the key reason for merging such a successful and large entity like HDFC Ltd with HDFC Bank, it was mainly the managing the cost better and to stay competitive and leader in the market. When you talk about the cost of funds is a key driver for any financial organization or a bank. Because it's the net interest margin, the interest margins which the organization make from the money which is borrowed versus the money which it lends in the market, it drives its profits. If you look at the cost of funds for the bank, it was around 3.9%, whereas for the HDFC Ltd, it was around 6.7%. So bank was able to take funds almost at 40% lower rates. So you can imagine how challenging it is for a home finance company to take funds at a much higher rate but give loan at the same competitive rates at which the bank is giving. And that's the reason why most of the NBFCs get into more higher margin loans rather than products like home loans, like vehicle loans or the car loans and the gold loans, which have margins of around 9% versus the margin around 3% for a home finance company. And that's the reason such NBFCs like Bajaj Finance, they enjoy much higher valuations of with P2 price to book ratio around 8.2 versus that of HDFC Bank around 3.2. So I hope this video of mine gave good insights on why HDFC Ltd, which was formed in 1977 by famous Mr. Hasmukh Parekh, with an HDFC Bank which was formed almost 2 decades later in 1994, and which has put India again in the global top 10 ranks. Thank you and look forward to see you soon.